Hello, I'm Natasha. Welcome back to my channel. And today I want to talk about foreign ownership in the UK. Now, the UK has a very relaxed approach to foreign takeovers. In fact, there is no specific law governing or restricting foreign investment. In today's video, I want to explore whether or not this is a good thing for the UK itself. This is topical given that it has recently been agreed that the British company Royal Mail will be sold off to a Czech billionaire. Just a side note, I am very interested in economics, having worked in finance in both the public and private sector in London for a good part of my 20s. So, Thatcher led the revolution to deregulate markets in the UK and allow for foreign investment. In 1979, Thatcher inherited a bad economy, large debt, a balance of payments deficit, and she started to sell off assets to generate cash for the government. She started with Amersham International, then energy, telecoms, water, and utility were all sold off. £19 billion was raised from privatisation between 1979 and 1987, and these Thatcher reforms made the UK the most open market in the world. However, Lord Mandelson in 2009 in the Wall Street Journal stated, "I have started to become concerned that over a lengthy period of time, UK manufacturing could be a loser." This was when Kraft began to pursue to take over Cadbury's, which it ultimately succeeded in doing. So in today's video, I want to really examine whether foreign takeovers are a good thing for Britain. How does the lack of rules in the UK compare to the rest of the world? I would argue that the government approach to this, like most things, has been extremely short-sighted to the detriment of the UK. So why essentially has the UK allowed such lax regulation in this area? The UK is in love with the banking and service sector, and many financial institutions in the UK make a lot of money out of buying and selling companies. What are the key problems with the lack of specific laws governing foreign investment? Firstly, the key concern of foreign takeovers is the loss of jobs in the UK. Now, of course, this won't happen every time, but it does happen. For instance, when Kraft took over Cadbury's, various undertakings were made at the time of the takeover about employment levels, plant closures. However, the Somerdale factory was closed and production was moved to a sister factory in Poland. Kraft also froze pay of employees and closed the Cheltenham headquarters. Chorus, the Anglo-Dutch steelmaker, was bought by Tata of India. It had factories in Port Talbot, Scunthorpe and Teesside. As the recession hit in 2009, 2,500 jobs were cut in the UK, mostly in depressed regions that were heavily reliant on heavy industry. More recently, the Body Shop, an originally British company, is set to appoint administrators in a move likely to result in lost jobs and shop closures. The Body Shop has been bought by a pan-European private equity investor. I would argue that foreign owners are more likely to cut jobs in the UK if needed, whereas a British company would more than likely be fully based in the UK and may be more incentivised to keep on British labour. There's also a risk of loss of skills within the UK as a result of foreign takeovers. These are skills which have been acquired through research and development, for instance. Westland, Britain's helicopter manufacturer, in 2001 merged with Italy's Finmeccanica division. This merger led to 1,000 jobs being lost in the UK. Most research and development also moved to Italy. When the leader of Westland mentioned next generation technology, the UK received no mention, as the skill set had gone in the UK. The UK sold off British Nuclear Fuel Limited Power Station. This had a construction arm, Westinghouse, and it was sold to Japan's Toshiba Corporation. It was one of the handful of designers, manufacturers, and builders of nuclear plants across the world, and it was being disposed of just as nations from Finland to China were looking to invest in nuclear ownership. This had offered Britain an opportunity to become a leader in the sector. While allowing such businesses to be taken over by foreign companies, we are losing essential skills to develop certain industries in the UK itself. We are also losing the chance of expanding British manufacturing and, crucially, growing the British economy. I think that there is an even bigger issue, and that is the loss of British manufacturing. The UK government seems absolutely obsessed with a service-based economy, but in modern times, recovery from recession has been export-driven. From 1997 to 2007, the share of Britain's economy making up manufacturing went from 20% to 12.4%. A report by accountants PwC stated that in the peak of the 2007 banking crisis, the square mile generated £67.8 billion worth of taxes for the government, but this was dwarfed by the £1 trillion rescue fund. A lack of vibrant manufacturing base impedes economic recovery. In previous decades, British manufacturing has showed amazing resilience in times of economic hardship. The devaluation that occurred in 1992, when the UK came out of the exchange rate mechanism, was followed by a boom. The same happened after the devaluation in 1967 and 1976. In all cases, the UK was able to take advantage of cheap currency and build exports. In 2011, following a 20% fall in the sterling, car manufacturers noticed a notable pickup in the volume of their exports. However, there is not enough of a manufacturing base in the UK to give the economy the whole support that it needs. Also, manufacturers have to import key components from overseas because so much of the supply chain in Britain is disrupted. Indeed, Sir James Dyson stated that the lack of British-made components was a major consideration when he made the decision to move manufacturing overseas to Malaysia, as he could not find the components in the UK. Another key risk is the loss of research and development when a foreign company takes over a British company. ICI Imperial Chemical Industries was lost to foreign ownership, and science and industrial expertise were lost. It did have a strong R&D function and products were emerging, but it was sold off to Germany. In 2007, a government report showed that R&D in the UK increased in British-owned firms, but declines in foreign-owned firms. Foreign corporations now control 39% of UK patents. Glassmakers Pilkington, which was British-owned, was bought off by Nippon Glass, a Japanese company. It became a major global player and pioneered to perfecting techniques of floating glass. There is a risk, therefore, that foreign takeovers are leading to critical R&D functions being lost in the UK and transferred abroad. Another key consideration for allowing foreign owners to invest so heavily is transfer of profits and loss of tax revenues for the government, and something I am surprised is not really scrutinised by the government. For instance, when Cadbury's was taken over by Kraft, it was paying £125 million a year in tax. However, when it was taken over by Kraft, this bill decreased by half or more. When Boots was taken over by an Italian company, its previous £89 million tax bill shrunk to £9 million. According to data from HMRC, tax receipts from parts of the economy affected by overseas takeovers has remained flat or declined, and therefore the shortfall has to be met elsewhere in personal tax, NI, and VAT. Of course, domestic companies can also reduce their tax burden. I'm not saying they can't, but the loophole for foreign companies buying British companies should also be reviewed. I would also like to raise the point that British companies that remain in British hands can do wonders for the British economy. The contribution a major industry can make to a nation's economic welfare can be seen with a company like GlaxoSmithKline based in Brentford. It is the world's third largest pharmaceutical company. It has a vast global research and development base and a rich portfolio of products. Today, it employs 16,000 people in the UK and is Britain's biggest spender on R&D and invests 7 billion annually. Tesco shows how a great British brand can be built. It became the world's third largest retailer behind Walmart and Carrefour. Then, if we take a look at Mini, which was bought by the German manufacturer BMW, 100,000 Minis are produced each year in Oxford. German ownership has saved the brand, but could a British company not have done the same? Then I think we also need to consider what other countries do. And just to give you some idea on the figures, from 2006 to 2010, foreign investment in British stocks exceeded $1 trillion a year, reaching 1.2 trillion in 2010. This far exceeded 910 billion flowing into the German economy, which is much larger, and 214 billion into Japan. France have foreign direct investment rules which require a foreign investor to file a request with and obtain authorization from the French Minister for the Economy prior to making a covered investment. France do not allow foreign energy companies to compete in domestic markets. They argue that it is against their national interest. In Germany, foreign direct investment screening is governed by the Foreign Trade and Payments Act. The government can veto foreign investment of 25% or more if the venture is deemed to be a national security threat. In Spain, FDI requires prior administrative authorization when carried out in sectors which affect public order, public safety, and public health. It seems like everyone apart from the UK has strict rules on foreign direct investment, and I would argue that Britain needs an urgent review of its rules. We need to assess the short-term versus the long-term impact of selling off so many British companies. Let me know what you think of my video and the content of my video in the comments below.